Now, Senegal is planning to sell a second Eurobond worth $500 million, joining Nigeria, Ghana, and Rwanda as some nations tapping the foreign debt markets from the continent of Africa. To review the appetite for foreign borrowing in West Africa, I'm now joined on the line by Samer Gadio, emerging market strategist at Standard Bank. Samer, thank you so much for joining us as always. I think the key thing about looking at these Eurobond issues is that they seem to be happening at about the same time. Of course, Ghana is in the market. Nigeria is looking to get into the market. Do you think the fact that so many of them are coming at the same time is going to be a challenge for fundraising for many of these countries?
I wouldn't necessarily say that the fact that they're coming together would be an issue. If the market environment was as supportive as a few months ago, I
right.
think those countries would have issued Eurobonds at decent yields. The problem is that they, to some extent, have missed an exceptional window of opportunity when it comes to external funding cost, and with yields going up across the board, and given the risk of environment right now in emerging markets, it could be that actually they struggle to get a relatively attractive yield when they come to the market.
Right. What's your sense? I mean, you just make a very good point. I mean, looking at Nigeria, for instance, like you mentioned, if they had issued this a few months ago, they could have issued at closer to 4%. Now it's closer to 6%. And your thoughts about where it could be and where could they finally issue, say, another month from now? Do you think that yields are likely to continue to move higher for emerging market bonds?
Well, basically those yields are going up because of two reasons.
Right.
One, U.S. Treasury yields are going up as a result of market concerns over the pace of quantitative easing in the U.S.
Yeah.
But that also triggered a widening in emerging market spreads. And so if you look at EMBI plus, for example, that's the average emerging market spread of U.S. Treasuries, it's widened to 395 basis points as of now from 291 last month.
Right.
So it could be that at some point, this correction eases somewhat and that spreads actually compress to some extent. But if you look at the medium to long-term outlook for U.S. Treasuries, well, those yields are likely to go up if the pace of QE is reduced. So I would say that, net-net, yes, probably the yields that we're seeing now are a little bit on the high side, but at the same time, it's highly unlikely that those new issuers will be able to place Eurobonds at the kind of rates that we had in early 2013. So,
right.
Again, they've missed a very attractive opportunity, unfortunately.
Indeed, they have missed that opportunity, like you rightly mentioned. So let's run through a few of them. Nigeria, Ghana, Senegal. Your thoughts on these bonds in particular and the investment opportunities they present in a global context? Of course, many of the investors that will be putting money into this have the option to invest in sovereign debt all across the world.
Well, Nigeria was trading very tight until recently, so at 4% actually in early May. And frankly, we did not recommend this Eurobond because we thought that those valuations didn't offer value. True, the Nigerian Eurobond is somewhat also supported by domestic financial institutions which have to match assets and liabilities in dollars. But, at the spreads that we had a few weeks ago, it didn't make much sense.
Right.
At 6% plus, I think there will probably be international appetite for the Nigerian Eurobond. After all, external debt is very low. The country has a decent track record, and so it's unlikely that there will be any risk of default anytime soon. So that will probably fly. Now, when you take countries like Senegal and Ghana, I think you have to be a little bit peculiar. In the case of Senegal, obviously yields have backed up to almost 8.4% recently. That's a spread of 636 over.
Right.
The problem is that Senegal really doesn't have an underlying story in a sense. I mean, you have large current account and fiscal deficits and a non-diversified export base. So it always makes it a little bit difficult to sell the story when the market environment is somewhat risk-off. I mean,
right.
That said, everything depends on the price, obviously. If they were to issue at 8.75% as in 2011 or at 9%, I think, yes, there would be appetite.
All right.